Good morning, good afternoon, good evening. Fire away with your questions. I'm here every Monday, or at least I try to be, answering in real time your questions about the real estate market, your questions about mortgage. If you missed it last week, we got quite a few days, Wednesday, Thursday, Friday, of mortgage rates trickling down for the first time. So in this video, I'm going to talk a little bit about if we expect this to continue, will rates continue to go down? I'd love to have some conversations about whether or not you, be it the consumer, real estate agent, whoever's watching this, think that it's a good thing if mortgage interest rates come down, because depending on your market, it may or may not be a good thing. And I'll explain more as we go. But those of you that are hoping for a big, fast drop in interest rates, you might have seen last week from somewhere in the 8% range all the way down to 7.3 or 7.4, depending on what you're looking at online for like an average for somebody with great credit. Rather steep, right? If we saw that every single week and we saw rates in the high fives or low sixes anytime soon, I can tell you with almost absolute certainty, it would be horrific for the housing market. In the current environment we're in, where there's no inventory, the last thing we want is to put a steroid into demand. And that's exactly what drastically lower interest rates would do. So quite honestly, those of us that are rooting for a healthy housing market are rooting for rates to stay in this range, call it 7 to 7.5% for a little bit of time, right? Over time, I think it would be fantastic. And I'm actually banking on it, betting on it, and speaking it into existence that call it 7.5% today and call it 6% 18 months from now. If I had my way, I would just have it be a slow and steady decrease of 1.5% on the 30-year fixed rate mortgage over an 18-month period. I don't want 6% in January. I certainly don't want it in March and April when more buyers are coming out and demand is coming up naturally. Injecting that with some extra demand, getting everybody off the sidelines all at once would be bad. And you ask me why bad? Well, bad because we all, well, not all of us, those of us that were paying attention in 2020 and 2021 when demand was through the roof and people could get money for less than the rate of inflation. So essentially, people were borrowing at net free, call it. This caused crazy bidding wars, releasing inspection contingencies, things that are not very healthy for the housing market in terms of how fast things appreciated and how fast prices went up. But from somebody who works closely with buyers, I can tell you those weren't good times for buyers. Buyers were stressed out. Buyers were frantic. Buyers had to make a decision within 9 minutes of seeing a house whether they're going to offer. Then they had to get with their real estate agent to say, is this place that's listed at $799 going to take an offer of $870 or $880 to get it done? Do I need to waive my appraisal contingency and just pay whatever the gap is? Am I going to have to waive an inspection contingency and hope that there's no foundation or sewer issues that might set me back 50 grand? That's the environment we were in. So anybody hoping for 6% next week is essentially asking for that to come back, because with limited inventory, that's what it would look like. So with all that being said, you don't want to hear that. You want to hear what's going to happen with mortgage interest rates. And I can tell you, if we see more data like we saw last week, that is proof that all the Fed's manipulation has been damaging the economy like they're honestly aiming for so that they can tame inflation. Non-farm payrolls came in 30,000 below forecast, right? Forecast was 180,000, came in at 150. Unemployment was forecast at 3.8%. It came in at 3.9%. So unemployment's up, payrolls down, earnings missed the forecast too. 0.3 was the forecast. They came in at 0.2. And then ISM services were 51.8 versus the 53 forecast. Everything missed, which when that happens, it justifies the Fed saying, hey, we're paused. Our work is done here. It further justifies them not doing any more rate hikes to the Fed funds rate, which will translate into 30-year fixed rate debt and all debt for that matter. It also will justify next year when you start seeing, and you already have, Fed rate cuts projected for March, May, those future meetings. And so the question that everybody wants to know, will interest rates come down? They always want to know the exact, like when, Matt, on this date, does it go to this number? I can tell you, if we continue to see economic data like we saw last week, which I think we will, I think we've seen the high in mortgage interest rates. That's not to say that some black swan event or something can't come through and change that, but the current trajectory that we're on is a trajectory of mortgage interest rates coming down. As long as the unemployment data, the payroll data, the overall economic data is missing expectations and showing the Fed that the economy is slowing down. So that's that. BuzzTune. Thanks, Matt. Talk with Connor. You guys are a rock star team. I appreciate it. And I've got great team members. I've got Connor literally in the office right next door. He is licensed in 10 states, ready to chat with anybody. So I've got it actually scrolling across the bottom, greatmortgagebroker.com. I'm sure that's how you did it, BuzzTune. Fill out a quick form. You want to talk to me or somebody on my team, depending on what state you're in. We're more than happy to help. In this environment, it is fun to be a buyer. And that's something that I think people are missing right now, is how much leverage you have as a buyer and the fact that this isn't going to be here forever. More economic stuff like we saw last week and more decline in the mortgage interest rate, the more competition comes. And there's no solve for inventory. So there's no, quick fix, couple million units get built or anything, quite honestly, that's going to cause a bunch of people to list their homes. And so it's going to be more competitive next year than it is right now. I can say that with a lot of certainty. I know it to be true because right now interest rates are high. Seasonality tells you that during the winter, not as many people are buying. And so I've got buyers who wouldn't have dreamed of getting a large seller credit, paying at or below the list price for a neighborhood that is very, very high demand neighborhood. Great neighborhood. I won't name it near me, but deals that are being put together are pretty sweet deals. So fire away with any of your questions. I'm going to try to stay on for at least a 30-minute clip here. I think it's valuable if real people ask real questions that are relevant to today, because real estate mortgage changes quickly. And those of you that have any inkling of buying or just are, having fun following the real estate market, really need to be tuned in and doing the work so that you don't take some perception of what you think is going on in the market from what you looked at 3 months ago. Quite honestly, that's what's most people do when they pick up a newspaper, that by the time it got printed, the data is so old it doesn't matter. It's like a August report that got released in September and the newspaper wrote about it in October. Now you're reading it in November. That data is so old, it's irrelevant. Good evening, Mr. Kevin Hawthorne. Appreciate you being here, man. Hope all is well with you out in Florida. I'm going to pull up mortgage interest rates because people always want to see that. While I am, fire away with any questions you have. Yeah, today was a slight uptick. Today we gave back a little bit of our gains from last Wednesday, Thursday, Friday. But the good news is we didn't give them all back. And quite honestly, we want it to be slow and steady. We don't want to go from 7.5% to 6% overnight. Okay, what do we got here? I'm going to adjust this chart. I'm just going to go from January 1st, 2023 to present. Pretty much been above 6% all year long. All right, here we come. Fire away with your questions. Ideally, this is a Q&A. I'm going to run out of things to say if I'm just guessing what questions you have. But if you guys have questions. All right, here we go. The blue line is the 30-year fixed rate average from Mortgage News Daily. Started the year 6.5 range, got down in February to about 6%, and then saw rates get up here above 7 by March. Kind of rode this 6.5 to 7 range through the summer. And I saw something interesting today that I was going to share. What's his name? Does great stuff. And I'm going to forget it when I'm talking about it right now. But I'll remember and I'll give him credit. Talked about how the market is more sensitive to rate movement than it is to the actual rate. Meaning that when rates go from 7 to 7.5 or 7.5 to 8, that 0.5% movement has more of an effect on buyers than the actual rate. So that what that would tell you is that the longer we have 7% plus, 6.5% plus interest rates, and people get used to it and accustomed to it, the less effect that rate has on people. Because the true effect is the fluctuation or the increase. So I think that we've, lived through 18 months now. If we went back even farther, and we see that August of 22, or even back here, where we started to get a taste for it in June of 22, we're going on a year and a half of being above 6% for the most part. And so people are starting to get used to it, and it's not going to have an effect on the market. What's going to have an effect is these 0.5% swings. We didn't see a lot, quite honestly. And still the jury is out on whether or not 8% to 7.5% is going to have an effect where, buyers come back. I don't think it will. And chime in if you're a buyer, does this going down to 7.5% excite you in any way? Does it make you want to go out there and buy, or is it just it went from high to still high when it comes to mortgage rates? I'd be interested to hear some, buyer sentiment on that. But this is just a snapshot. Mortgage interest rates at or above 7% since May. So that's a good 6-month clip where we're used to that by now. It doesn't really have the effect it has than it did like during this big run up. This drastic change is what buyers react to. And so they're more stuck here in April and May because of how much it's gone up in the short amount of time than they are here where there's a higher rate, but they've seen it for 6 months, if that makes any sense. God, what is the name of, does a great job on YouTube, Mike Simonson from Altos Research. See how the brain works? I knew if I gave it enough time, it would simmer up to the top. So he talked about the fact that they're more sensitive to rate changes than they are to actual interest rate. Thanks, Mike. That was a golden nugget. I'm glad I was able to remember where I heard it. All right, BuzzTune, question. And please fire away questions. We got at least a couple dozen people joining us live. And so help me help you by firing away with any and all questions you have, because rest assured, your question is one that others are going to have. If not, I'll talk about some things that I'm seeing and some conversations I'm having outside of this live, but I'd love to, get the questions from you live. If you have one investment property but don't have a primary, does that exclude you from first-time home buyer programs? Yes, it does, and I'll tell you why, BuzzTune. The definition of first-time home buyer is somebody who has not had ownership interest in a piece of real estate in the last 3 years. So you could be somebody who owned a home from 2005 to 2019. You sold it in 2019 for whatever reason, and you've rented or you traveled or whatever you did. Now you buy in 2023, not having ownership interest in a house in 3 years qualifies you as a first-time home buyer. What will disqualify you is the case you're talking about, where you own an investment property, you own a piece of real estate. You wouldn't qualify for first-time home buyer programs, which, quite honestly, as much as people are always clamoring for what's the best first-time home buyer program, I'm looking for, that special program. There's not much to it, like 3% down versus 5% on a conventional loan, maybe some down payment assistance programs that give you some assistance for being a first-time home buyer. But quite honestly, there's not really any free lunch when it comes to first-time home buyers. There's no program where like, holy moly, I wish I had access to that, because they're giving away 10% of the purchase price. They're giving me a rate that's 1% lower than the second-time home buyer that's putting 10% down. It's just not the case. There's just not that much to it. So the fact that you're not a first-time home buyer doesn't mean you don't have access to great mortgage products. All right. Well, I'm waiting for you guys to fire away questions, and you guys are really slacking in your macking today. I will briefly talk about a video that I just recorded, because I think that it's more common today than in past. And maybe it just is a bigger percentage of the conversations I'm having because of the fact that there needs to be some sort of life event for some people to buy right now. It's just the market where you got to be in the market to buy. People aren't buying just for shits and giggles. They're buying because they got a job change. They're going through a divorce. And so on the owner occupied stuff I'm seeing more and more divorce stuff. The video will come out. It'll be on my channel in the next week, talking about the rules for buying a home while going through a divorce. A filed marital separation agreement, filed MSA that's been entered into the court is something that you're going to need. And people sometimes try to put the cart before the horse before anything's been finalized, or they've even, entered into discussions about how everything's going to be distributed. They're trying to, one or the other is trying to buy a house. Quite honestly, especially in a community property state like California, you got to have that at the very least filed, entered into court. On government loans like FHA and VA, you actually it's got to be done. You got to be officially divorced. If not, as you may or may not know, that current spouse, even if it's separation, you guys are getting divorced, we're gonna have to include all of their debts, have an application on them, and know that it's going to vary based on what state you're in, but keep that stuff in mind. It's you want to talk to a professional, and you want to get some guidance on how you're going to do that, and importantly, the timing, because a lot of people are just like, oh, you know what? I make good money, so I'll be able to just buy this new house, not realizing you guys have community property assets, and you're also both tied to a loan. We've got no idea about alimony, child support, distribution of assets, all of that stuff. So it's going to be something where, unfortunately, like, I'm in the business of helping people create life-changing opportunities through home ownership. So I want to help you buy a house. Trust me, you might just have to wait, and that's okay. So greatmortgagebroker.com is how you connect me and my team, and we're happy to talk you through that, give you any advice. The advice in California is going to be a little bit different than the advice of some other states, but for sure, you want to talk to a mortgage professional before you go out there and get yourself in a position where, you know, you make an offer on a house that you can't close on because of the fact that you've got debts that need to be included, or you're trying to buy a house where, in a community property state, the person that you're separating from, divorcing from, is going to have ownership interest in that if you buy it while you guys are still legally married. So enough about that, but I think it's something that is important to talk about because it happens. And my hope for you is that it's an amicable situation where you guys can part ways peacefully, get along, figure out the settlement agreement, and then the real estate and the mortgage part that comes after, we gladly do once everything's resolved. All right, Jay Homeboy, how you doing? I appreciate the support. Thanks for the question. I haven't even read it yet, but I thank you just for questioning. And if you're in the comments or you're watching this live, fire away. If you're watching this on replay, fire away in the comments, because I'll go through and I'll try to answer as many of those as possible. It's easier to get me live than it is to get me after the video has been published, because there's lots of questions across 800 plus videos that pop through every day. And I do my best to answer them, but I probably can't get to all of them. Would mortgage personnel know any changes or still ask for verification after closing to jobs or financial situation? This is a great question. I have no idea where it's coming from. So I have no idea what you're up to, Jay Homeboy, but hopefully my homeboy's not up to anything crazy. The verification of employment that lenders will do at the very end of the mortgage transaction is for this reason. And it's literally at the point of drawing docs, where somebody from the lender is calling and saying, I want to make sure Jay Homeboy is still working at FedEx. And they go, oh no, his last day was Friday. He came in here, gave us two middle fingers, and just told us to take this job and put it where the sun don't shine. And he's done. That happens, we can't fund the loan. And, in regards to job or financial situation, we're going to verify it throughout the process that you've got verified income and assets. Like I said, that job part comes at the very end, because unfortunately, this stuff happens where, there's layoffs. I had one, wasn't super recent, but it was right at the end, literally drawing docs, and my borrower was getting laid off. And honestly, I don't think it was even something that was caught by the lender. My borrower told me, and we decided to hold off because he said, I don't feel good signing these documents. On the closing documents, it says nothing has changed. And, this person, being a person with integrity, said, I'm not going to sign something that nothing with my employment or my financial situation has changed. The good karma that came back to him was, this was at a time, sometime in 2021, where we ended up, he got the new job. We did his refinance where he felt good about signing documents that were true. And August of 21, 2.5%, 30-year fixed. That's what you get for being honest. So anyhow, hopefully that answers your question. Now that I'm rereading it, you're talking about after closing. There are, in some cases, some post-close audits. And I think the way that most lenders do it is, you've got a bunch of different mortgages. They start pulling out one here, and one here. and doing a post-close audit to make sure that there's not any issues with that loan. That being said, if a month after you close a loan, you get laid off, you had no idea about it before your loan closed, that doesn't disqualify you from getting the mortgage you got. Hopefully you can still make the payment. Hopefully there's another job lined up. Hopefully there's all that. But, you know, to the same degree, if you had 400,000 in the bank and you showed all these reserve funds for a loan you got, and then you closed on it, and you decided, you know what, I'm going to take these funds, I'm going to go buy a fourplex. Then you had $0 in the bank. Like, that stuff shouldn't and wouldn't affect you. So hopefully that answered it. Oh, man. I need more coffee. All right. Final call for questions. Fire away with what you got. I'm here and I'm happy to answer them. I've got a lot of stuff to get to. I'll remind you, like I said in the beginning, people are winning right now. People are winning on the buy side. Investors are putting together deals you wouldn't have imagined and wouldn't have got 6 months ago, for sure. Buyers who are buying their primary residence are buying in neighborhoods that were so competitive during the summer, they didn't even want to compete. And now in that same neighborhood, they're able to not just get their offer accepted, but get it accepted with seller credit, put together a great structure. So I would encourage you, if you're watching this, whether live or on the replay, and home ownership or an investment property is on your vision board, it's part of your goals. I tell people this quite often, and I believe it wholeheartedly. It doesn't hurt to be prepared for opportunity. Whether you buy next week, next year, or never, if you do the work to prepare and you understand exactly what it's going to look like to purchase, then you've got that. You're prepared and you're ready for opportunity. Those that tend to miss opportunity are those who wait for the opportunity to present itself before they prepare. And that's not going to win in this market, in my humble opinion. I've got people that are ready. They're on the sidelines. And that's why interest rates coming down really scares me a little bit, because I know how many people are on the sideline, fully pre-approved, ready to roll, looking for opportunity. Whether that opportunity is a discounted price or some credit, or maybe, you know, interest rates come down to where the payment looks a little bit better or makes the numbers work in the investment property. I don't know, but you want to be prepared for it. So go to greatmortgagebroker.com, get yourself pre-approved, get yourself ready. We're happy to help. Thanks for watching. Hopefully this helped you. Till next time, we gonna see.